Lessons from the trenches of tax season. How can getting a better interest rate on the money you have in the bank, on your money market, how can that impact your Social Security and the tax that you pay to the tune of a few $1,000s? Got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, we are into tax season here and have a really awful, kind of frustrating example to share with you, really from the trenches of tax preparation and tax planning. Has to do with, I'm changing some of the details here, keeping things confidential, but retired couple. They are, in their 70s. And so they've got, I would say, pretty average, maybe even a boring financial situation and tax picture. They've got some money in the bank account, in their bank account, and they're making some interest on that. They've got some retirement dollars, but they also have a decent amount that they've stored up in a non-retirement account, but that's mostly being kept in CDs and treasuries and money markets. It's really safe, earning interest there. They've got a pension, small pension, about 20 grand. And then they each have Social Security. Each of them, their Social Security is around 25 grand. So all in, if you just look at that, their income's about 70 grand a year or so. And on their taxes, because so much of that has come from Social Security, they've really been in a favorable situation. And what I mean by that really boils down to, how is Social Security taxed? Every single year on your tax return, there's a calculation that's done when you're drawing your Social Security, and that calculation is all of your other income plus half of your Social Security. If that number exceeds, $32,000 for a married couple filing jointly, then some of your Social Security starts becoming taxable on your tax return. And a little bit, for the higher that number is in that calculation, more and more of your Social Security starts becoming taxable. Well, if that calculation is above $44,000, then most of your Social Security ends up as taxable on your return, up to 85% of your Social Security. No, the tax isn't 85%. It's just 85 cents of every dollar of Social Security will become taxable to you on your federal tax return. So you can see that kind of that math. It's a very, very small runway, short runway. 32,000 to 44,000 goes from none of your Social Security being taxed to upwards of 85% of it being taxed. So pretty short runway. Well, in these folks' situation, if you think of their non-Social Security money they've got, or taxable income, they've got the $20,000 pension. And then, they've had, going back a couple of years, the interest on their bank accounts has been pretty small. In 2023, it was a pretty big jump from what it had been in the previous years. They had about $5 grand of interest income on their bank accounts and that money market and CDs and whatnot. But it still, in 2023, caused very little of their Social Security to come over as taxable. Some of it, but very little, landed as taxable. And doing that calculation, that little bit of Social Security plus the pension plus the interest minus their standard deduction, they were in a really favorable tax situation. Well, here's the struggle. Because in 2023, interest rates that you had on your savings account, or if you had any CDs or anything like that in this non-IRA account, interest rates started 2023 still pretty low. And rates were going up throughout the year, and it wasn't until about the fourth quarter that interest rates peaked. And if you had a CD, or if you had investments or money markets that were at a lower interest rate, 2023 was certainly a better year for collecting interest than 2022 and previous years. But you weren't collecting the highest amount of interest for the entire year versus 2024. And most people think, well, interest rates 23 and 24 were pretty similar, right? Well, sort of. 2024 interest rates were at that highest level, had maxed out, had peaked for about 3 quarters, and then started to decline at the end of 2024 in the fourth quarter. Well, this particular client, as interest rates rose, they actually locked in those really high interest rates at the end of 2023 and locked in some of that money in this non-IRA account. And they locked it in at around 5.5%, some CDs and whatnot. And even because interest rates were so high, added even some money to that from checking account, bank account that wasn't earning much in interest. So in 2023, I told you that the interest that they had from their bank accounts, $5,000, $6,000, something like that. In 2024, completely a shock to them, the amount of interest from what they had in the bank, from the CDs, because again, they had locked in at a high interest rate, was around $15,000. I think $14,000 and some change. An additional $9,000 of interest income landed on their tax return in 2024 that didn't land on their return in 2023, and yet their mindset was, we probably earned about the same amount in interest. Well, what that $9,000 did, when you add that to that calculation of how Social Security is taxed, it ended up making another $9,000 of their Social Security land as taxable on their tax return. Again, that very, very short runway of all of your other income plus half your Social Security, if it's above $32,000, they were really in a comfortable zone prior to this interest becoming much higher. And when $9,000 of extra interest income landed on their tax return, it impacted this calculation such that another $9,000 of Social Security ended up as being taxable. So an extra $9,000 of interest income caused their taxable income to go up by $18,000. It moves them from getting about a $900 refund the year before to owing about $1,000 on their tax return this year, a $2,000 swing. Now, is that the end of the world? No, it is terribly frustrating though. I'd rather pay tax on more income than less, right? I'd rather have the extra interest income for sure. But an extra $2,000 of tax on what really is just an extra $9,000 of interest income, that's a pretty high relative or effective tax rate, even though they find themselves in the 12% tax bracket, simply because of what that interest did to how their Social Security is taxed. So what's the takeaway? I can think of two. One, being aware of how tax on your Social Security works so that you're not caught off guard by this, so that you're able to take advantage of tax shelters and so on and preserve or protect yourself from this calculation. That's one, and really leads right into the second, and that is leverage those tax shelters. Contribute as much as you can, get as much as you can growing in those tax shelters as possible. And when it makes sense, advantage Roth, right? Do Roth conversions, make Roth contributions so that those dollars are in those tax shelters and never end up being taxable on your return again. Work with your certified financial planner on that to optimize your tax situation right now so that you can improve the calculation on how your Social Security is taxed out there in the future. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.